Hi, thank you so much for checking out this quick video that I did explaining a little bit more about the importance of understanding the pro forma, reading the pro forma, so that you can make a better decision on your investment that you're about to take on. So, the first thing that we're going to do now, this one, obviously, I'm just showing this to you in a video and I took a screenshot, so I can't edit any of these fields. There are a lot of fields that you can edit on here. And let's start at the very top. So here's the sales price. We're not going to mess with that. That's going to stay the same. The next price, down payment. This is just an estimated number. This number is 3% of the purchase price. It's going to change because it's not a guaranteed number until we know exactly what your closing costs are going to be with your lender, what their fees are. The time of year that you close will also change because you have to pay for the remaining taxes for the balance of the year. So if you close in January, then you have a year's worth of taxes you're going to have to pay at closing. If you close in December, then you have 1 month's worth of taxes you're going to have to pay at closing. So that number will change. So I just wanted to kind of get that out of the way. This is just an estimated number. But if you go a couple lines down, it says depreciable closing costs. What does that mean? You can actually write off your closing costs on your taxes. So this is a number now, again, this is just a general estimated number based on what we would assume, we've done thousands of closings, what we assume your closing costs are going to look like. When you get your closing statement from your bank, make sure that you keep a copy, write it down, save it in a special file, what your closing costs were. Give it to your CPA at the end of the year, and that is a write-off on your property for that year. So that's really important to know. Now, we're going to skip through all of these things because there's a couple of areas that we really don't talk about often that I want you to take a look at. Now, we're going to skip all the way down to net performance. So on this first category right here, on net performance, it says $934 for the month. This is the income without the mortgage payment. So this is including, we're taking out property taxes, insurance, property management fees. These are the items we know we're going to have to pay. We also know we're going to have to pay a mortgage unless you decided to pay all cash for your property. So we're going to take out the mortgage payment. Now, again, it's just an estimated number until you get the number from your lender specifically. This property will cash flow at $216 a month. Okay. Another important number right after that is principal reduction. Every single month when your tenant writes you that rent check, they're paying your mortgage for you, they're paying your taxes, they're paying your insurance. A portion of this mortgage payment, a portion of the $719, $191 of it actually goes to pay your principal reduction on that property. So I like to look at this as if this is free money. This is money because you're not paying for it. Your tenant is literally paying that for you. So this is this is a number that people really don't talk about a lot, but your mortgage is going down and the tenant is paying it. So that's $191. Then we're going to look at the next line, first year appreciation. So this property particularly has an average appreciation rate of 4%. Now, obviously, we know markets change. This number can go up much higher. It can also go down much lower. Recent years, this is a very, very, very conservative number. This actually would be closer to 5 or 6%. But using a more conservative number, we're going to put that 4% there. And I like to use conservative numbers. So we're going to add in that first year appreciation. That's another $450 a month in your pocket. So then we're going to add these up, and we're adding these up, and that's $857. Then we're going to add in the tax savings. What a lot of investors don't realize is you can actually take a write-off on your depreciation value of your property every single year. Now, depreciation of your property is something you need to talk to your tax accountant with, but make sure that you bring it up because you can write off a certain percentage of the we know on paper there are real estate loopholes. We know that your property is going up in value. That's what that 4% is showing you. Your property is actually going up. My favorite real estate loophole is the depreciation, because on paper we get to say the property is actually going down in value because, the house is being used, it's being lived in, there's renters living there. And so whatever that percentage is, you get to write that off with your CPA every year. You don't have to take it out every single year. You get basically 27 and a half years, you get to take out a percentage. That's why it's kind of a strategy with your CPA. You can take it all out in 1 year. You could take it all out in 5 years. So we're just going to use an estimated tax savings number here right now. So basically what we're looking at here, every single month, the total is $939. That's really what you're gaining every single month on this property. So when people talk about cash flow and they want to know what is coming into their pocket each month, that's a good number to know. So when we look at the next column over here where it says monthly cash flow, $215, that's good to know, because that's the difference between the bills that you're paying every month that you're going to see. But then we are not actually giving value to all those other hidden numbers. The principal reduction, the first year appreciation, the tax savings. Those are kind of the hidden numbers that you will see, and you will reap those rewards down the road. So one of the most common mistakes that I see investors do is focus on year one. And I think that is being short-minded, short-sighted, because unless you're planning to buy that property and sell it in 1 year, there is no reason why you should be just looking at year one. Of course, we want to be reasonable. We want to look at year one and go, okay, great. The math makes sense. It's fine. Like on this property, it says year one, cash on cash return. At the very bottom, lower right-hand side there on the column, it says cash on cash return, 8.3%. That's a lot more money than you're going to be, than your money sitting in a bank account. So that's how I like to look at cash on cash return. That is how I calculate that on my proforma. We take your down payment and closing costs and we divide it by the purchase price, because that is the money you have into the deal. So, you have $31,000 into this deal, according to this spreadsheet where it says the total cash invested at the top. I want to know how hard that $31,000 is going to work for you, how it's going to work for me. Do I want to leave that money sitting in a bank account, or do I want to actually put it to work? That's the actual cash. And so this property is earning 8.3% year one. Great. That's easy. That's a no-brainer, because if you're leaving it in your bank account and you're going to earn less than 1%, then if you're happy with that, it's okay. But then we have inflation. We know inflation is going up. So every time every month you leave your money in your bank account, we know it's actually going down in value, because the money is not working for you. It's just sitting there. The bank is actually using your money and investing it. That's a whole other topic. So we want your money to start working for you. So year one, we're sitting there at 8%. Great. That's a win. Now, unless you plan on selling that property the first year, we're going to ignore year one and we're never going to look at it again. Now we're going to jump ahead, and that's why I love this pro forma so much. We're going to jump ahead to at least year 5. I want you to get into the habit of comparing all properties you're analyzing by year 5. Now, as long as you're using my pro forma and you have rental increases and you have a proper market appreciation number, then there's no reason why you should not be evaluating your properties by year 5, year 10. Because remember, this is a long-term investment. Why would you just focus on, year 1 or year 2? We want to look and see what this property is going to be doing for you in the future. So if we jump ahead on year 5, for example, and we're going to look all the way over on the right-hand side of that spreadsheet on the cash on cash return. Year 5, this property is earning 11.31% cash on cash return. Your money is working really hard for you. And a lot of this has to do with rental increases. A lot of times, obviously we're going to not pay attention to that year 1, because the rents are going to be the same for that year 1 that we are anticipating. But your property manager is going to take advantage of rental increases whenever they can. So in this example, we're using a 2%, which is normal for this market. So I want you to to realize that year 5, that 11.31% now has rental increases. That's it. And that's great. So now when you're comparing properties and you're comparing a property in a really high growth market, like let's say Florida, and you're comparing a property in a more linear market, that number is what's going to help you decide if you're going to pull that trigger or not. In addition to the cash flow number, of course, because we are still looking at that. But then the biggest picture here is don't forget to look at year 5 for your equity. What is the wealth that you're creating on this pro forma by year 5? So if we look at equity accumulation on the same right-hand side, year 5, equity wealth, by year 5, you have $62,000 worth of equity in that property. Amazing. And you literally didn't have to do anything. It just sat there and went up in value. With the tenant paying your mortgage for you, real estate, it's a no-brainer, even with the interest rates that they are now. And that's the cool thing about real estate investing. It's not an emotional decision. It really is all about the math. And we do not have a single property that pencils out bad on paper. Otherwise, we're not going to show it to you. We're not going to give it to you. There is no reason why you should not be continuing to invest. Even though the interest rates are at 7% right now when I'm recording this, it's still historically low. The math still makes sense. And that's what's so cool about running the numbers this way is, 8% the first year. Amazing with that high interest rate. Then we're going to get the principal reduction of almost $200. We're going to get the first year appreciation of $450. We're going to get the tax savings. Really, you're getting $939 a month on this property. Where are you going to get that anywhere else? And that's the biggest thing that I wanted to drive home with this example is really think about what you are gaining with real estate. Don't give in to the fear. Don't give in to, the predictions. And, we've been hearing that we're going to hit a bubble or a recession for the last 5 years. Do you think that stopped any investors from investing? Absolutely. A lot of people were scared and a lot of people didn't invest the past 5 years. But think about it. If you invested 5 years ago on this same property and you'd be sitting on that type of equity now, there's no regrets. So at the end of the day, we need to make sure that the property is rentable. We need to make sure that there's rental high demand there. We need to make sure that the property is maintenance free as possible, that there aren't going to be a lot of expenses and costs that you're going to have to pay for. We want to make sure that your property manager is placing a good quality tenant. One thing that we do know in any market recession or downturn, rental demand goes up because real estate is not a luxury, it's a necessity. And when you have people that could possibly, lose their jobs or companies shut down in a possible recession, they need to work somewhere and they need to live somewhere. So housing is always going to be extremely important. And it's really nice to be able to provide a nice, safe home for somebody, a home that has been newly renovated, a home that has been fixed up in the neighborhood, a home that is, providing a sanctuary for somebody with new roof, new windows, new appliances, that are energy efficient. It really does feel good to be a landlord and not, a slumlord, which we don't want our investors to be. We want you to provide nice, safe housing for individuals to live in. And that's why we back all of the teams that we work with in each of our markets, because we know they're doing a great job in their areas and bringing, great upgrades to communities. And I mean, so many great things. So here, that everything in a nutshell is, if the last thing I'm going to say, hopefully I'm drilling it home here, is really look at the future numbers to decide if an investment makes sense for you, and then just use logic and go, okay, what would I be doing if I wasn't doing this? And then make a decision based on that. Again, I'm here for you. Just let me know what you need. Let me know if you want to talk to any of our lenders. If you have questions about this pro forma, this is probably one of the most important things you can learn right now is, while everybody else is frozen and in fear, you can continue to grow your portfolio. You can grow your portfolio in any market because it all just comes down to the math. So, and the math is easy to follow with real estate. Nothing emotional about it. So I'm excited for you to take the next steps. Let me know if you have any questions. You can reach me. Here's my email up above, and I look forward to talking with you again. Thanks. Bye.